Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family. And each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. And I hope you enjoy this final interview preview with Chuck Carnevale. So final question, and I probably already answered this, but in the case you want to throw something else in there, I'll give you the chance.
All right.
Yeah. So, according to some researchers, the average active investor sees annual returns of less than 3%. So based on almost any metric is obviously notably underperforming. So in your observation and all your experience, why do you think so many DIY investors struggle to find success? Again, we've named a number of these already, but I'm curious if there's anything else you'd want to throw out there.
Well, you kind of bring up an interesting, soapbox of mine. This idea of labeling investments as active or passive, to me, is really shortchanging what they are. So my advice is don't be too active. One of my favorite old sayings is a portfolio is like a bar of soap. The more you handle it, the smaller it gets. And one reason, one reason I think a lot of individual investors, don't generate better numbers than they do is because they're too active. They buy and sell too much. Making a good decision on a great company is difficult, especially if you do your homework properly. And once you make that decision, the best thing to do is stick with that decision. So, kind of going back to what we talked about earlier, my approach is that I want to position myself as a shareholder partner in a great business that able to invest in at an attractive valuation. And then I want to be a shareholder for a long period of time. So, don't be too active. That's probably the biggest mistake that I think investors make. Make a good decision and stick with it for the long run. And, generally that'll pay off for you. But, it's not, I'm not an active investor. I'm also like Buffett. I think the best holding period is forever. And when I make an investment, I don't judge it for less than 3 to 5 years, but my intention is permanently, until, something changes with the fundamentals of the business. I'm there for the long run. And, I think that's some of the best advice. Buy and hold is not dead. As long as you buy the right companies at the right value and monitor their success. You don't want to own the greatest buggy whip company in the world when Henry Ford comes along. It's time to leave buggy whips, but you don't want to do that every day.
Sure.
People just tend to be too impatient with their investments.
Well, another interview I've done with someone on this summit, we talked about the idea of 100 baggers, which sounds very cliche at first, and it sounds very, hot growth stock type stuff, but it's actually a book called 100 Baggers. And the idea is the author studied basically in the history of the stock market, or maybe the last 60 years of the stock market, what companies have increased in value by 100 times. And a lot of them are really boring companies like Colgate and stuff like that, but
they also did it over decades and decades.
Exactly.
They didn't do it in 2 quarters.
Exactly. Right? And that's the difference. And I feel like that's kind of part of your point too, is that understanding that long-term time frame and the power of it is so significant because like in that other interview, he said, if you make a $10,000 investment in a company that grows by 100 times, that becomes $1 million. Who cares if it takes 30 years? That's just incredible.
I agree with that, but also it's going to take 30 years.
Sure.
This idea of, getting rich overnight in the stock market is, it's analogous to getting rich overnight by going to the casino. It can happen. It does happen maybe 1 out of 1 million times, but generally it doesn't happen. It's the tortoise and the hare kind of story. Buy good businesses and be a partner and own them for, as long as they remain good businesses. That's, to me, the best way to invest capital over the long run.
Absolutely. And I can't think of a better way to wrap up the interview than that. So
right. Good.
Yeah. Well, Chuck, hey, thanks so much for giving us your time today. It's just great to be with you.
It's been my pleasure. I've enjoyed sharing with you.
I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.